Welcome back to QAV America. Tony, episode 17, recording this on the 5th of August 2025. We talk too slowly, according to somebody on YouTube.
Really? Okay.
So can you speak faster this time, Tony?
I always have to try and slow myself down usually.
Well, not fast enough for this person on YouTube. How have you been, Tony? You've been following the US market?
Very well.
You've been reading the Wall Street Journal this week, Tony?
I have, yes. Read the Wall Street Journal every day.
What have you learnt about the US market from the Wall Street Journal this week, Tony?
I learned if you don't like the stats, fire the messenger. That's what I learned this week.
Yes.
Yeah. And it's a lesson that we've seen taught to us many, many times in history.
Yeah, as we were talking about in our last show, as people may or may not know, I've spent the last 20 years doing mostly history-related podcasts, and a lot of it on Soviet Union and the Cold War, and it is very reminiscent of, an ideology-based state like Soviet Union under Stalin or Communist China under Mao, where you have a particular ideology and messaging that you want to convey, and if the facts and the data don't map neatly to that ideology, you deny it, you ignore it, you arrest the people that are promoting it, and make sure that you end up with a culture, with a society where everyone is too scared to speak the truth, and they just say things that they feel they will be rewarded for, and that's the problem. It's a slippery slope then into a society that ignores facts and data, and it's not a good thing for society. It's not a good thing for industry. It's not a good thing for business. It's not a good thing for investors. Hopefully this trend in the US gets turned around at some point soon.
Yes, cutting the man to fit the cloth is never a good idea. And I've seen it. I mean, it's kind of a corporate approach to things too. I mean, I've seen this plenty of times in big businesses where the boss wants a number, and lo and behold, when you come to your results, you hit the number by hook or by crook, even if it's manufactured sometimes.
Well, I think I will just do a quick portfolio update for our US portfolio. I did have a look at it this morning, and let me see. For the last 30 days, our portfolio was down 1% versus the S&P 500, which was up 1%. For the last 12 months, our portfolio is up 19% versus the S&P 500 up 18%. And since inception for our portfolio, which is September 2023, we're up 56% versus the S&P 500 up 42%. And as I said to you on our last show, the big success in our portfolio is Willis Lease Finance Company, WLFC, which by the end of last year was up like 300% since we bought it. It's come back about 30%. So now it's only up about 200% since we bought it. But a lot of the retreat in our portfolio this year has been Willis Lease Finance Company giving up its 300% returns down to 200%. So our portfolio this year looks like it's been going backwards, but really it's just giving up some of the gains that it had already amassed last year. Still, 56% versus 42% for the S&P 500 is a nice return in September 23. So not quite 2 years, but almost 2 years, nearly a 60% return. It's pretty good.
Mm-hmm. Yeah.
Just on a commodity update this week for people who are new to our show, when we're investing in commodity stocks, which is a big thing in Australia, we tend to look at the underlying performance of the commodities that the companies are built on top of. If they're a gold miner, we look at the gold commodity, or iron ore or coal. There were some changes when I looked at the commodity graphs this week. Iron ore has become a Josephine. For new QAV listeners, that means that it's in a buy state, but it's declining. So the price today is lower than the price was at the end of last month. The end of the month was only a couple of days ago, but it's retreating a little bit, but still in a buy state technically. But we would wait if we had an iron ore stock that was a buy on our buy list. If the underlying commodity is a Josephine, And I called it that because I'm a Napoleon buff, and Napoleon famously, supposedly said, "Not tonight, Josephine." Gold is a buy. Thermal coal is a Josephine. Coking coal is a buy. Crude oil is a Josephine. Copper is a Josephine. Wheat is a sell. Nickel is a sell. LNG is a Josephine. Platinum's a Josephine. Aluminium's a Josephine. Zinc's a Josephine. Tin is a Josephine. Steel is a buy, however. Lithium is a buy. So there's been some changes this week. Iron ore, coal, platinum, aluminium, zinc all became Josephines this week. Nickel became a sell and wheat became a sell. They were the big changes for this week. So if you're holding any stocks that are nickel or wheat based, you might want to think about selling those. Not financial advice. Do your own research. Also in our portfolio last week, I sold a stock for the first time in a long time. I had to sell ENIC, which I think I did a pulled pork on a little while ago. They became a Rule 1 sell and an advanced Rule 1 sell too. They dropped 20% below the price that we bought them at, so I let them go. And I replaced it with the company that I'm going to do a deep dive, a pulled pork on today, which is GTN, Tony. And I'm quite excited about this one. Like the company I did last week, this strikes me as another classic Berkshire type company. Kind of out of favor, a little bit boring, but generating a lot of cash. Seems to have a bit of a moat. And we'll see what you think after I do my deep dive.
Yes, please.
So
I like these Berkshire type stocks as a value investor.
Yeah, me too. And it's interesting to see them in the US market because we don't. I mean, maybe we do have a lot. I mean, we have a lot of sort of in the Australian market. Companies that are certainly out of favour on our buy list all the time because they're dirty mining companies. They're digging up coal or they're in oil or things like that, and so they're not ESG friendly. But we don't tend to get a lot of businesses like this one. We do have some television networks, and old media companies that pop up from time to time. GTN is grey television. They call themselves a multimedia company. They're really a television business with some add-ons. But I nearly bought this a year ago, July 2024, for our US portfolio. And then you talked me out of it because it had a bad Z score. That's when we were still paying attention to Z scores.
Okay.
It was a good call, though, because at the time it was trading at $5.51. Today it's $4.46. So glad you did talk me out of it. But now we're ignoring Z scores. It's back on the buy list. And I did add it last week. It has since become a Josephine at the end of the month. I will just call that out. So its price this morning was $4.46. At the end of the month, it was $4.51. So it's slightly below that. So I wouldn't buy it today, but it was okay when I looked at it late last week. So who are they? Grey, as I said.
Sorry.
Yeah.
I just want to explain why we look at what we call Josephines, not tonight Josephines, because the long-term trend might mean it's a buy, but we can probably buy it at a better price if it's lower than what it closed at the end of the month. So that's the reason for looking at the short-term trend as well. If the short-term trend is higher than the end of the last month, then the upward trend is still intact. It gives me more confidence that the momentum's behind this stock. Because if it's down, even in the short term, I don't know whether it's just...
Which makes you different from a classic value investor who just believes that if it's a good company, you buy it regardless of the sentiment, regardless of what's happening. You're a little bit more sensitive to sentiment because, as you said, if you can buy it cheaper tomorrow or a week from now, why not buy it cheaper then?
Correct. And if likewise on the sell side of things, like you said, you sold the stock, why the classic value investor would hold it and just say, look, the market's got it wrong and it'll wake up to itself. But my experience is that can go on for a long time until the market revisits the stock and comes to its senses. And I can better deploy my cash somewhere else in a stock which has sentiment behind it, but still is less than the value I ascribe to that company. And I may as well put my capital to work and go to work.
Yeah. Unlike Buffett in,
Mhm.
late era Buffett, late stage Buffett, let's call it that. It's not like we struggle to find things to buy, as we talked about on this show
Yeah.
last week. There's plenty to buy in the US market and the Australian market. And over the years we've been doing this show, there's only been a handful of occasions that I can remember when we couldn't find anything to buy, usually after a major market crash or,
Mm.
what do you call it? It's a something. The market's resetting itself, a market reset.
Yes. Yeah. A major downturn, like COVID.
And even those periods haven't lasted since we've been doing the show for very long. During COVID, it was a month, maybe a month and a half.
Yep.
We haven't been through anything like the GFC necessarily, when it might be longer, or like a really major reset. But anyway, okay, Gray, headquartered in Atlanta, Georgia, just up the road from my father-in-law in Augusta. According to their website, they are the nation's largest owner of top-rated local television stations and digital assets in the United States that serve 113 television markets, reaching approximately 36% of US television households. This portfolio includes 80 markets with the top-rated television station and 100 markets with the first and or second highest rated television station. So they go back to the 50s. A newspaper man called James H. Gray bought a TV station in Albany, Georgia called WALB TV. Then he started adding more stations, and they've continued to expand ever since, particularly in the last decade. They've bought a bunch of businesses. Interestingly, their headquarters now in Atlanta, Georgia, is a thing they called Assembly Atlanta. This was an old General Motors assembly plant for decades. It went out of business, I think, in 2014, something like that. The site was just huge. It's like 165 acres. They flattened it, and they've built there basically like a mini Hollywood. They've got studios and backlots and parks for the public to come, and it's like this whole sort of Hollywood in Georgia kind of thing, which they see as not only where they produce a lot of their TV content, that other people can come and produce content there. So it's sort of the cornerstone of what they're doing, Assembly Atlanta. And they're doubling down on television and film production, which is interesting. It's obviously a difficult time. We've obviously seen the announcement in the last couple of weeks that Paramount is shutting down the Late
Tonight
Show? The Late Show.
Tonight.
No, it's the old Letterman show. I think Stephen Colbert has.
Okay.
It's the Late Show. I think Kimmel's got the Tonight Show. Not Kimmel, the other one.
Fallon.
Jimmy Fallon. Yeah. Anyway, Stephen Colbert's show, whichever one it is. And they're saying because it's not making money. Some people don't believe that. They believe it's more political than fiscal. But anyway, I think it's a truism that the big TV networks are struggling in the era of streaming and TikTok and fragmentation of eyeballs and attention and all that kind of stuff. But these guys are doubling down. So interesting. In 2019, they purchased a company called Raycom Media, which owns multiple stations and also has a thing called Raycom Sports, which is a long-running sports production business. Goes back to 1979, produces live events and original programming for college football, college sport over there, which is a big thing in the US, as we know. In 2021, they bought a company called Quincy Media, which is a Midwestern station owner, gives them more coverage in small and mid markets in the Midwest. In 2021, they also acquired Meredith's Local Media Group, which added 17 TV stations and increased their national coverage. They have a brand called Tupelo Honey, which I assumed was named after an old Van Morrison song, but no, apparently Tupelo Honey is a real thing. It's honey that comes from trees called Tupelo trees, but the founder of this business, Tupelo Honey, named it in honor of his wife, who was from Tupelo, Mississippi, and he referred to her as his Tupelo Honey, named the business after that. But it did get me listening to Van Morrison all morning while I was preparing my notes. So that's never a bad thing to listen to Van Morrison in the morning.
So he wrote a song about grey media.
Yeah, in 1969, or
Right.
71 or whatever.
Cool.
71, I think that album came out. He predicted grey media, 1971. Tupelo Honey is a sports and entertainment production company, again, that focuses on live events and also connects fans with athletes and brands. So I think they kind of do deals with big sporting stars and do branded content and, entertainment programming, all that kind of stuff with them. They also own a brand called Power Nation, which is an automotive how-to brand for car enthusiast shows. They own a company called, they just announced they're buying a company, as long as it doesn't get blocked, called Block Communications. Let's hope Block Communications doesn't get blocked. It's a family-owned media company. They're in the process, they just announced a couple of days ago. It owns stations in Kentucky, Illinois, and Ohio. It says pending regulatory approval, which, as I understand it from the Paramount deal, means a cash donation to the Trump Library. They also own Third Rail Studios, which is a professional film TV facility. It was acquired in 2021 and then folded in. It has sound stages and production infrastructure. So they own all of these TV media production assets and locations and stations. Their business model is based around a couple of things. Obviously, selling advertising into all of these local markets. Local advertising, car dealers, hospitals, supermarkets, news and sports, but also on even years, political advertising. Got a quote here from one of their executives, which is political advertising revenue in even years is typically 5 to 6 times higher than odd years, because they have the midterms and the presidential elections, right? And this will show up when I do the numbers later on, because 2025 is not an even year. So their numbers for this year aren't going to be as good as they were last year and might be next year. Now, the revenue for next year is based on the assumption that there will be midterms. I'm skeptical about that. I don't think the US is going to have another election for many years to come, but we'll see how it plays out. However, we can't predict, so we're assuming that business will be business as usual. So they make money out of all of that. They also have retransmission content, or retrans, as it's called in the lingo, I think. This is the payments that they get from cable, satellite, and streaming distributors to carry the programs and the channels that they produce. And the good thing about that is that it's contractual recurring revenue. It's not based on advertising, doesn't really matter where the economy's at. It's not based on political advertising cycles. Advertising revenue can be lumpy depending on where the economy's at, where the jobs numbers are at. And of course, if you don't like the jobs numbers, just fire the person that came up with them. But they have this contractual revenue, which helps smooth out the bumps. They also sell production capacity. They have the ability to make shows, film live events. I remember when we were in when were we in Vegas with Ray and Markham, like
7 years ago, maybe?
15?
Was it
No,
longer?
it was during Trump. I know Trump was still in the primaries for his first campaign, because I remember having an argument with Markham about that. Markham was like, he will never win the Republican nomination. You don't know what you're talking about. And I was like, I don't know, man. And I rub that in his face every chance I get.
And for you listeners, David, our friend David Markham from Toronto was he was the head of Democrats abroad.
Well, he's not from Toronto. He was living
he lives in
Washington.
Toronto. Yeah.
Lives
he's
in
actually,
Toronto
isn't he
now,
from somewhere down south? Kentucky or something?
Yeah.
Yeah.
Yeah. Well, I don't think it's there, but yeah, somewhere else.
Mm.
Anyway, my point was going to be there was a guy there with us whose name I can't recall. One of the listeners to my Caesar show or my Napoleon show or something, who was a director for one of these live sports
Mm.
production companies. It may have been one of these, but I know he would just travel around and shoot football games and baseball
Mm.
games and that kind of
I remember
stuff.
him.
So these
Nice
guys do
guy.
that too. Yeah. So the reason that they're on the buy list, or the reasons, is they're generating a lot of cash, and their price to operating cash flow is, wait for it, 0.62. So that means if this was a coffee shop and we bought it, it would be able to pay us back in 6 months, 7 months. Yeah. Which is ridiculously cheap to be able to buy a business. Why is it cheap? And look, they are carrying quite a bit of debt. They've leveraged all of these acquisitions. And so, the market doesn't like that sometimes. And I think old-fashioned TV production is not sexy. It's not Netflix. It's not TikTok. It's not anything that's got AI involved in it. But on top of all of that, they're paying a 6.44% dividend. So that's good. Their F score, the Piotrowski F score, despite all of the debt, is 8 out of 9.
Oh, that's good.
So very, very healthy financial score. And you'll like this one too. The price to book is 0.17.
If this stock gets any cheaper, they'll pay us to buy. I'll give it away.
The price is $4.97. The book per share is $28.53. So it's crazy cheap. It scores its ass off too when I run through the QAV numbers. By the way, the average daily trade is about 7.5 million shares. So it's quite a highly traded stock. With the Stockopedia numbers, the quality rank is a 67. We score it if it's over 60, so it scores for that. The stock rank is 97, so we score it for that as well. I'm going to bring up the live numbers here so I can see it.
Yeah, so that's the quality ranking, I think, is it? There was 68. Yeah,
Quality rank
68.
Yeah, stock rank is 97, so we score it over 90, so it scored for that. The Piotrowski score, the F score, 8. We score it if it's over 4.5. So it scores for that. IV number 1, our intrinsic value number 1, which is our EPS over our hurdle rate of 19.5%, is $12.35. The price is $4.97. Well, it was when I did my analysis. It's $4.49 at last market close. So it's a third of the first intrinsic value number, roughly. We don't have an IV.
More stringent.
Yeah, usually the harder one, right?
Mm.
But here's the thing. It doesn't have an IV2 because the future earnings per share is negative. Net profit for this full year is supposed to be negative 82.8 million. But, that's because it's not a political advertising year is one part of it, right? So I drilled into this a little bit. They've got big depreciation and amortization charges. They've acquired a ton of stuff in the last few years. They've got a lot of intangible assets as part of that, a lot of licenses and goodwill, property, plant, and equipment like towers and stages that are all getting amortized and depreciated over time. Non-cash expenses, but it kills reported earnings with GAAP. So even if their operating cash flow is solid, and it is, operating cash flow for last year, 2024, was $3.644 billion. For this year, it's going to be down a little bit. It's going to be 3.173 is the expected. But next year, again, the midterms year, it's back up to 3.638. So, actually TTM is 3.6. Oh, that's probably carrying over some from last year. I'm not sure how that works. But bottom line is they're making cash flow, but a lot of amortization and depreciation, which is going to bleed through into their EPS. Interest expense is high. They're servicing billions in debt. The 2025 interest expense is about 120 million. So that's going to eat through profit, even if the operating metrics look okay. Bottom line is strong operating cash flow, strong F score. The core business seems quite solid, but the profit this year is going to take a hit. We don't have a double forecast IV because there's no IV2.
Mm-hmm.
Price is less than book, as I said before. It's also less than book plus 30. Book plus 30 is $37. Price is $4.97. So it's scored for both of those. Book value growth is positive. Obviously, price to operating cash flow, it's scored for that. The PE is 2.06. The yield is 6.44, as I said before. So it scores for PE less than the yield. And the yield is higher than the current bank rates. I think I've got 6.3, I think, for bank rates in the US, 6.44. So it's above that as well. And it has a 3-point uptrend and a new 3-point upturn as well. So it's scored for both of those. So the quality score, QAV quality score was 86%. The QAV score 1.38. It just killed on all of the numbers. And it's kind of been on the buy list for a long time too. Like, even though when you look at the share graph, it's been declining since 2022, but it's generating tons of cash and it's very, very cheap. So, I mean, there's a lot of things that could go wrong with this, being TV, as we said, etc. I mean, it's probably not as affected by the tariff wars, although if the tariff wars have a bigger impact on advertising revenue, or if there are no midterms because Trump declares martial law, or he's just arresting, they're arresting all of the Democrats. Did you see this in Texas?
No, I didn't see it.
In Texas yesterday, Congress there tried to have a vote. They were going to do some gerrymandering of the districts there, and all of the Democrats left the state, so they couldn't have a quorum, they couldn't have a vote. And now the Texas governor has issued an arrest warrant for all of the Texas Democrats who left, but they're all in New York, saying, well, your warrant's no good in New York, so good luck, come and get us. So, yeah, who knows how things are going to play out over the next year in the US. But again, we can't predict. We don't predict.
No.
What do you think based on the numbers, Tony?
Yeah, it looks classic value play. Question for you. It's based in Atlanta. Is that coincidence, or is there some kind of history or tie up with Ted Turner and his network? See.
Well, no, I said the founder of Gray Media, James H. Gray, bought a TV station in Albany, Georgia back in 1954, WALB, and they sort of come out of that. So, no, I think it's distinct from Ted Turner's operation. Didn't come up anywhere in my research. But yeah,
I mean, sometimes you see industries cluster in the one town, like auto does in Detroit, for example. Oftentimes you find there's a productive workforce to pick from who've already been trained in TV production. And so if you open up another production facility, you can tap into that. So that makes sense. Reminds me, I mean, it's a classic cigar butt stock, isn't it? Its price has declined quite heavily over the last 5 years, but it's had a bit of an uptick now. So maybe it's found its level. Certainly there are a lot of headwinds in the television industry. Kind of reminds me of Seven West Media in Australia that we covered on our Australian show a little while ago. And you asked me at the time when I talked about it, why would you buy a television station? And, my answer is because eventually the price is right. And it's this one in particular is throwing off so much cash. I mean, you threw some numbers out there about operating cash flow paying you back in 6 or 7 months, which is just amazing. And I looked up the numbers on Stockopedia while you were talking. Even if you don't like operating cash flow as the metric and want to use free cash flow, because as you said, there's amortization and depreciation going on with all the takeovers. Free cash flow per share is still $6.33, and the share price is $4.49. So you're still getting paid out of free cash flow more than what the share price is, which is, kind of unheard of and crazy, I think. And I guess the market's taking a bet that TV will keep declining, but a lot of things happen in these industries when they go into decline. There's consolidation that can happen. There's a lot of merger activity, even with Seven West Media, since we spoke about it. There was parts of the network being sold off and parts of other people's networks being bought, etc., which supports the current industry. You see it in any sort of industry in decline. There's always one or two players who get left holding the baby, and it can be turned into a profitable sort of industry, even though it's much reduced as an industry compared to what it was. And this, looks like it might play out in a similar sort of way. There's so much cash. And I guess the last point I'd make is even though it's got lots of debt, I can see it being paid down over the last couple of halves. So cash cures debt. If you have lots of cash coming in, you can pay down the debt. And if you do that quickly enough and you've still got the cash flow, it's a terrific business to be in. And the time to buy it is now, not when people wake up to the fact it's paid down its debt and it's throwing off even amounts of cash flow.
Yeah, well, unlike the one I talked about last week, this one I have added to the portfolio, as I said, because they were high up on the buy list when I needed to add something this week to replace ENIC with. Mm-hmm. So let's see how it goes. See what they do with all of that cash. And again, it's sort of part of the QAV philosophy that when you've got a company that seems to be well run, smart people running it, they're generating a lot of cash that we trust that they'll figure out what to do with it to, hopefully make the business bigger and better, or sell it to somebody else who's going to make it bigger and better.
Well, that's right. This is a classic acquisition opportunity, isn't it?
Or, who knows? Who knows who wants to come along and, like Larry Ellison's son, David Ellison, who's buying Paramount, which owns CBS. Like, he was a production company who made he got started making a documentary about himself because he likes flying planes. He's a pilot. And so he sort of, I think, self-funded with his dad's Oracle money, a documentary about himself, and then ended up co-producing Mission Impossible films, and now is buying Paramount.
Oh, so he's Skydance. He's Skydance, is he?
He's Skydance, yeah.
Yeah, right.
I think Skydance was the name of the original documentary.
Oh, okay.
I think. So anyway, yeah, you know which startup's going to come along and decide they want a bunch of television networks and production facilities and cash flow and pick it up. So yeah,
and it's a double-edged sword, but the streamers are getting into sports broadcasting now. I see it all the time when they open up Apple and Amazon. They've got the latest NFL game or whatever, or EPL game on them, and so. They're business people. They've got to say to themselves, if we want to get into college football, do we go out and create a network from scratch, or do we go over to this company and make them an offer on their sports broadcasting unit? Because it's cheaper. So I think M&A plays into this. I can't predict, but it's so cheap. You've got to think that we're not the only ones who are looking at it.
Well, that's GTN. And that's
Excellent.
QAV America
that was a good,
for this week.
Good value stock. Thanks, Cam.
Thanks, Tony. Have a good one.